You're tuned to the Leadership Strategy Foundry with host Neil Evans. In each episode, he interviews top influencers in the financial services business sector. One of them might just spark that idea that ignites your bottom line. Here's Neil.
Welcome to today's episode of the Leadership Strategy Foundry. For those of you just joining us, we specialize in helping portfolio operators and growth-focused companies identify opportunities to scale revenue and improve execution across their business units. Today, we're joined by a guest with a unique perspective on private markets, investment advisory, and capital strategy. Today, we're joined by Chris Matthews of Blackfield, a boutique private investment office serving executives, family offices, and sophisticated investors. Blackfield operates as an investment advisory firm, not a private equity or venture capital firm, with a focus on helping clients navigate private markets, secondaries, structured opportunities, concentrated positions, portfolio risk with discretion and institutional discipline. Chris brings more than 2 decades of experience across public and private sectors, equity, structured finance, special situations, distressed assets, restructuring, digital assets, and other complex investment areas. Chris, great to have you on this episode of Leadership Strategy Foundry. And pardon me for stumbling over that a little bit, but I think we can rock on, okay?
Thanks for having me, Neil. Appreciate it.
My pleasure. Great to have you. So, Chris, Blackfield sits in a very different lane than private equity or venture capital. For context, how would you describe what a private investment office actually does, and what pulled you into that advisory model?
Yeah, a private investment office is built around one idea, really. It's treating a client's capital the way an institutional CIO would, right? Full flexibility across markets, public, private, credit and equity, real assets. It's kind of similar to what you'd find at a larger, more sophisticated family office. Traditional wealth management often starts more with asset classes and then fills in the allocations. We start with a portfolio as a whole, and then we ask, what risks are worth taking, how they interact together, and then whether the expected return justifies those risks. So it's much more of a risk-adjusted return perspective. And I think, for where we focus, the difference really shows up most clearly in alternatives. So, instead of approaching them as these individual one-off opportunities, we look at them as like a coordinated part of the whole portfolio. We look at pacing, illiquidity, how each position kind of fits within the broader capital structure for that client. And I think, to answer your question at its core, it shifts from managing investments to managing capital.
And how did you get into this? What was your kind of lineage, your little bit of 5 minutes of history or whatever?
Yeah, I actually fell into finance almost 30 years ago now. And so I started my career at Lehman Brothers, and I was, really a creative that fell into finance. And so my curiosity because of that kind of naturally took me to a lot of different asset classes. And I think what was really, really grateful for was that in each of the seats that I was in, they were always with kind of the idea leaders, the people that were frankly just far more intelligent than I was. And they were doing things that were normally, early asset classes or things that were, I don't want to say on the fringe, but they were new. So when I joined, I was in banking, doing structured finance and what were called esoterics. Those were the first days of CLOs, and I got a picture of that. And that was a great team. And then I went down to institutional research equity sales, had the privilege of working with arguably one of the premier salesmen on the street. We covered a who's who of legendary investors that I got to, grow up under. It was very intense. But again, ideas were really the focus about how to impact a portfolio. But that was on the equity side. And then I left and I went to a boutique that was a carve out of the old Drexel, Bernard Lambert. They were a very specialized player, very strong in distressed, bankruptcy, restructuring, special situations. And so I got to see how the full capital structure works, what happens through the cycle of a company as it goes through stress, how it reemerges, And I got to teach a lot of my clients that were more on the institutional equity side about that. And then, from there, I moved and left into, again, what was an earlier asset class, which was digital assets over a decade ago. It was kind of early to that trade. Spent some time in music royalties after that. And then once again, found a partner, former client, who was very idea oriented and very driven about being differentiated. And that's my partner, Ted Liu. And that's what Blackfield focuses on.
Oh, great. Well, nice, interesting. You've done a lot of turns in your career so far, huh?
Yeah, I like to tell younger people that I speak to when they're trying to figure out where to look in finance and where to differentiate themselves. And I always tell them that it's really hard to look into the fog of the future, right? And beyond 3 or 5 years, it's pretty hard to, especially in today's world, to anticipate where things are going. But following your curiosity, following things that are kind of new. It seems to make more sense when you look back at the breadcrumbs. I mean,
Hmm.
I feel very fortunate to sit in the seat that I am in right now, having the experience of different asset classes, because it gives me, and us a real interesting niche, but also ability and menu to focus on different investments as opposed to a single asset class. And it didn't make sense maybe as much at the time, but I wouldn't be able to do now what I was doing back then simply because of the experience.
Yeah, just a wider view. So when you're working with executives, families, or sophisticated investors, what tends to be the first thing they're really trying to solve? Is it access, liquidity, risk, complexity, or even
Mhm.
something I'm not thinking of?
Yeah, I'd say usually it starts as access on the surface, but underneath it's always decision confidence around something new, right? So education is a really big piece of it.
Hmm.
They're trying to answer, what would I actually own if I was buying this? What risks am I taking on? How does it compare to something else in the portfolio? So I think the real problem is in filtering that complexity into more of a thoughtful allocation with an institutional lens.
I have to think that the education piece of this, because most people's purview does not include types of things that you're, working on, right? So just explaining what a particular asset does, how it works, what you actually own, et cetera, could be pretty daunting for, even a fairly sophisticated investor, maybe, right?
I think so. I think the institutional market, is a understanding of alternatives in particular and privates.
Mhm.
They've been larger players with heavier concentrations. I think the advisor community, for sure, this is a steep learning curve getting to understand some of these assets, and there's really like an ocean of product coming at them. And I think that's to your point, it's a challenge being able to address that either as an investor, but then be able to explain it in a way that's coherent and makes sense in someone's portfolio. I mean, listen, we've been in these assets for a long time. We've structured them, we've banked them, we've traded them, up and down the capital stack. And so we have some familiarity. So when we see a PPM or something that has, great length and complexity to it, we understand how the underwriting process is kind of being done. We don't maybe know credit by credit what's in there, but we know a little bit what's going into the sauce in the kitchen, and that gives some comfort. But certainly, there's hand holding to get people comfortable. But again, to my earlier point, I think when you find yourself earlier in asset classes than others, it's kind of similar to just being into investment a little bit earlier. A couple things can happen. You can either lower the risk profile a bit simply because it hasn't drawn as much capital, but it also may turn into different return profiles as well, depending on what the asset is. Simply because you have a tailwind of other people discovering it, getting smarter, and capital goes where liquidity flows is the old saying. And so
Hmm.
when you can get into something early and then a lot of capital comes into it, you get a little bit of that tailwind that can help you. And I think being smart on the front end is an advantage.
Blackfield's work seems to sit heavily around discretion and long-term alignment. In practice, how does that typically play out when a client is evaluating a complex private market opportunity?
Yeah, I think in private markets, the investment itself is only part of the decision.
Hmm.
But again, education plays a very big role. So let's say timing, there's liquidity, tax consequences, concentration issues. Sometimes they're family objectives, what they're trying to accomplish. I think those all matter. So, like the discretion that comes in, it's more about, spending more time slowing down the decisions versus speeding them up, and then getting aligned with the, client and looking whether or not this opportunity even belongs in the portfolio for the first place. Not if it just kind of looks attractive on paper, if that makes sense.
Yeah. A lot of investors are, being introduced to private markets and alternatives in ways that may not have dealt with before, right? Where does that become challenging from, your perspective? We talked about education, but where else?
Yeah, again, education's a real challenge, but I think also structure,
Mm,
right? Private investments are inherently just more complex, but they're presented usually to clients or they're coming at you one by one, right? But portfolios don't experience risk one by one,
hmm.
right? There's illiquidity. If you have a basket of managers, there's manager dispersion, fee layering you need to be sensitive to, all the various documentation. If you're not careful, they can all accumulate pretty significantly over time. So what looks manageable at the individual investment level can become much more complex at the portfolio level, even if it's actively managed.
No, gotcha. You've spent time across public and private debt and equity, structured finance, distressed situations, restructuring, and special situations. When you look at an opportunity today, what are the early signals that tell you the risk is not being fully understood?
Yeah, through every cycle, I think there are just periods where expectations and the underwriting standards get out of whack, right? You see it in venture, lending, you kind of see it everywhere. And, if you're having conversations and they start to be more about upside and less about loss potential or liquidity risks,
Hmm.
I think that starts to tell you the underwriting is starting to get a little bit more loose and maybe risk is being mispriced. I mean, for us, we just naturally tend to focus on what can go wrong, and then we start from there.
I think being a sound risk manager is probably the most important or the key. What have you got? What are you gambling? And how much risk can you take, right?
Yeah, I think that's actually the name of the game in all of investing. People talk about credit this, do you own that stock? Are you all involved in this or that? But at the end of the day, almost being agnostic to anything and just looking at it as a one and a zero almost, you really need to look at the portfolio mix, the portfolio management, not just the research analysis. And I think this is good. I think this isn't quite as attractive. And I think that's a key differentiator, actually. Anyone on the street, certainly on this on the the buy side institutionally, everybody learns how to be an analyst, right? They learn either how to be a credit analyst, usually credit and equity. They understand cap structure, and everybody kind of learns how to do that part. And you can have opinions, and you get arguments for why they should be in portfolio. But then there's the seat of the portfolio manager. And the portfolio manager is a completely different skill set than that. The skill set there is well, first you already needed to have the credit analysis kind of like down pat. But now your job, your task is to have trigger point execution skills.
Hmm.
And that's just very, very different. It brings in emotion. The framing people talk about as being on tilt or off tilt. So, how do you size something in a portfolio once you decide it want to go in? When do you buy it? When would you sell it or redeem it? How do you act when things are maybe getting a little bit frothy? What do you do when everyone's running for the door? I find that, from what I've seen from investors over decades, the best buys and the best sells are the times when you don't want to do it.
Hmm.
And that's just really challenging.
Yeah. So Blackfield appears to spend meaningful time around private secondaries and concentrated private positions. What usually drives someone to seek advice in that situation? And where do those transactions tend to become more complicated than expected?
That's a good question. I think it may start with like a liquidity event, some kind of liquidity event of some sort, private stock or a fund, something that's illiquid. And then the complication starts to come from that,
Hmm.
right? So someone maybe has this large fund position, or, they were at a company and they have a large, company stock exposure. And then they start to realize that they have to figure out valuation. They have to figure out transferability. Are there problems with it? What are their taxes? What are the timing? I think they're all connected. So like what seems on the surface like a simple sale can turn into a pretty complex capital planning exercise. And you have to remember, like these can also be, transformative events for the holder and their family. So emotions always get tied up into it in some way or another.
Oh, for sure. In secondary transactions or private market liquidity situations, where do things most often break down? Is it in pricing expectations, timing, documentation, counterparty coordination, or something else?
Yeah, a lot of that, but I'd say expectations tend to break down first. Yeah.
Yeah.
I think, sellers often anchor to some headline number, or price evaluation. But the buyer is always underwriting a host of other things. So like transfer restrictions, information rights, timing uncertainty, concentration risk. They're thinking, an underwriting process on their side. So even when you're, accessing this through funds, the same dynamics are what ultimately drive the pricing and liquidity. And I think that creates a very meaningful gap between what's perceived value and executable value.
Got you. You've commented on how private markets remain very human and messy, right? Even as
Mhm.
technology and platforms keep trying to make them more efficient, right? AI, whatever. What do you think that is, and how does that typically show up in actual transition transactions?
Yeah, private markets are messy, right? Because they're transactions that are negotiated. They're not cleared on some exchange like you would on your, Fidelity app trading, stock, right? So
Mhm.
every deal has various stakeholders. Sometimes there are consent requirements. There's always information asymmetry, sort of from the private party maybe versus the party that's buying. There can be legal structure in there. There's no centralized process for that price discovery like you get in a public market. It's a big difference, right? I think, there are a lot of platforms out there to help with this, like, and technology can improve that visibility and reduce some of the friction, but it doesn't change the underlying reality that, these are still bespoke human negotiations. Even at the fund level, I think the administrative side is pretty heavy. It's a burden. You have subscriptions, redemptions when you do them, the ongoing management and paperwork if you want to change particulars for a holder or the position, and all that documentation and all those approvals. It still feels paper-like, right? So the operational burden doesn't fully go away. I think it's still early in the private markets, but there's a lot of progress. But again, it's still pretty early.
As you look at the current private markets, where do you think that things feel less predictable than you'd like valuations, liquidity, manager selection, credit risk, or even client expectations?
Yeah, I think the biggest issue is the interaction between liquidity and valuation assumptions,
Hmm.
right? Right. So if you look at like markets, and the easiest one is to look at equities, people are familiar with that. And for a long time, a lot of private assets were priced in an environment where capital was abundant, and there were easier exits to kind of assume or model. And then the IPO market kind of shut off, the new administration, and things got a little more tight. I think today, have timing visibility, financing availability, buyer behavior is kind of unknown and less predictable. And all of that together, I think, makes the underwriting discipline just far more important.
Hmm. And complex for sure,
Mhm.
right? Yeah. So Blackfield's work requires balancing opportunity with downside protection, right? We talked about risk management. As the advisory
Mhm.
business scales, Where does the pressure tend to show up first? Is it sourcing differentiated opportunities, diligence, client education? We talked about that 4 times, transaction execution, or ongoing portfolio oversight.
This is for like advisors looking at their
Mhm.
book.
Yeah.
Yeah. So the pressure definitely tends to show up in, I think, the ongoing portfolio oversight after
Mhm.
you've, already allocated. Like selection is tough and challenging, but I think most advisors underestimate what happens after you've committed that capital, right? I'm just thinking like, private portfolios require a lot of very quiet maintenance. You have to, you know, monitor the manager, liquidity planning. Sometimes you need to re-underwrite the investment. You need to make sure that the exposures don't drift, unintentionally over time, so your weightings kind of move around. I'd say this is arguably like the least visible part of the process, but frankly, it's where portfolios either, stay disciplined or they wind up losing control and getting a little bit out of whack.
Got you. So this is a question I like to ask every guest that just, kind of throws a little curveball at you. But if you could wave a magic wand or you had an Aladdin lamp, but you only get one wish, right? To solve one challenge within your own business or the investment process today, what would that be?
Well, on our end, we're a very active advisor in within alternatives. So, we spend a lot of our time on research, talking with managers, digging into portfolios. We're trying to constantly de-risk, as I mentioned earlier, right? We also get visibility on funds before they launch, at seed level, and so that whole process is a heavy burden on the front end. But I think once we get moving and we decide to be in, or after a period of time, redeem or move out of a position, say after there's no tax consequence, um, there's an administrative burden for that, right? We don't do things where we just, like I mentioned in the earlier, example, we don't just have like one fund that we might put someone into, or, a one-off. We look to assemble this the same way we would other diversified portfolios. So, we may have ideally, it could be 5, 7, 10, 15 different, alternative subscriptions across asset classes with different exposures, different kind of parts of the capital structure that we're making a reflection for both equity and credit. And we want to diversify across managers, right? So you can see it starts to get more complex. Right now, even though there are systems out there like iCapital and others, you can do the subscription process. But a lot of the advisor community is very passive. I'd say even the allocator, institutional allocator market is a little more passive. They go into an investment and they, buy in and support a manager, or in the wealth channel, they get, one fund for income, maybe another, position for like an equity, single stock, what have you. And then it's just kind of there and waiting to see what happens. We're not passive, we're active. And so that paperwork is a process, and that would be a great thing to solve. I think, frankly, it's a little bit of an advantage because a lot of people don't want to do it. But it's a friction layer, and if I could push a button right now, rub a lamp to make a genie come out and make that happen, where we could just simply just click, 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 that'd be great. I think we might be heading more in that direction over time, but we're not there yet.
Got you. So you can't give advice about investments for sure on, on this type of situation, but can you maybe provide some advice about investing in general? What somebody should look at, what should they examine? We talked about risk management being so critical, but along those lines.
Yeah, I think there's always three questions or three problems that manifest themselves for anybody. It's, when you look at something, what people think they're buying, what they're actually exposed to, and then what work at what level have they done on it. I think it's a very important thing to recognize what your skills are and where you can focus. I think maybe because investing has been socialized in a way, there are apps like Robinhood and they have these flashing green lights that come in and get you to buy a stock. And I think we become very familiar with investing and trading, and it's just become part of society. These terms, years ago and decades ago and longer, the term used to be speculation. It wasn't investing. But today you can open up an account, have zero commissions, and be day trading something, but you're an investor. And I think they're just very different, again, skill sets, and the market has a way of removing capital from one party and shifting it to another over time. And so investing is just a really unusual space. I think you need to appreciate it as another very professional career. It's a very difficult thing to do, and do your own homework and appreciate that way. Not many people go out, maybe with AI it's a little different today, but would go out and not hire a lawyer, but go and start doing all their own legal cases. Right? Not many people would go out and start being their own, sophisticated tax, attorney. They certainly wouldn't do it, with a doctor where they're on the table at home thinking, I'm going to go do, open heart surgery. And yet it's interesting in the investment space. There's kind of that perspective where people think they can do it. It reminds me, Ray Dalio had an analogy from some years ago where he said the psychology behind investing is that the individual investor will, get into certain positions, and maybe a stock or two will start to really go up, right? Maybe it goes up 50% or 100% over a couple months, and confidence builds with that recency bias. And they think, wow, I could really do this. And the way he talked about it was, the investor has a couple good days, and they think that, maybe they could go and similarly line up at the Olympics in the 100-meter, final, and have a shot. On a good day, they've got a shot at it, right? And, he's very right that, the institutional investors, the people that pour into these markets are dropping billions and billions of dollars to eke out every edge they can to compete against you. It's more hard than that, probably, to eke it out, especially in public markets. And so I think that's a very difficult thing for people to appreciate because, again, as I mentioned, you see apps, you see stories, and you see narrative, and it's very easy to make money and gamble. But it's a much harder thing to do from a more of a professional perspective.
Gotcha. Great sage advice. Well, listen, Chris, first of all, before I forget, if folks in the audience would like to reach out to you for advisement or whatever purpose, can you please share how they would reach out to you? And I'll get that chyron on to the bottom of the podcast.
Yeah, I appreciate that. So you can come at our site if you like at blackfield.capital. You could reach out to me individually at Chris, CHRES, at blackfield.capital. And I'm also on LinkedIn if people want to reach out.
Awesome. Chris, thank you so much for joining me in this episode of Leadership Strategy Foundry. I know that this is going to be one very, very popular podcast, and I appreciate your time. So with that, I'll just say this is a wrap.
Thanks so much, Neil. Appreciate the time.
Take care.
We hope you enjoyed the session and hope you picked up a pearl or two. Just a parting note. Of the many business leaders to whom we speak, we find that one of their most pervasive issues is about filling their pipelines with qualified leads. If that's an area of concern where your organization could use an assist, head on over to aisolutionsfoundry.com and book a complimentary strategy session. This is one of our many programs that help organizations like yours build financial value that drops directly to their bottom line. See you on the next episode of the Leadership Strategy Foundry.